All right, my name is Carlos McWhorter, CPA, and today we're going to do a stock review of Dick's Sporting Goods. Why is Dick's Sporting Goods in the news and on the top of people's minds right now? It's because recently they announced that they're going to purchase Foot Locker for $2.4 billion. Now, as an investor in Dick's Sporting Goods since 2018, when I first heard this news, I wasn't the most excited. Yes, they've been acquiring some companies here and there, but they haven't acquired a very strong brand. And sometimes when companies do this, they run into trouble. The thing is, when you have a stock like Dick's Sporting Goods that's been such a great dividend growth stock. I bought this in 2018. They've grown their dividend every year over 10%, double digit growth. Sometimes they've grown it over 20% in 1 year. Sometimes they've grown it multiple times, twice in 1 year, along with special dividends. So this company is dominant in what they do, and they are generating a ton of extra cash, and they're giving it to the shareholders with stock buybacks and with great dividend growth. So that's what I like about this company. But companies that do this typically aren't heavy on the acquisition side. And here Dick's Sporting Goods just announced a heavy acquisition, what I would consider a heavy acquisition. But I want you to think about this. Like I said before, companies, when they are managing a brand and that brand pretty much does one thing, sporting goods, they're dominant there. They're not dominant in what Foot Locker does, which is different. Even though they sell sneakers and some apparel, is different. You have a sporting goods brand and you have what's typically more of a fashion brand. If I go to Foot Locker, I might be buying some shoes to play basketball in, but typically I'm just buying shoes to wear. I'm going there for fashion. If I'm going to Dick's Sporting Goods, I'm not typically going there for fashion. I'm going there for performance. I'm looking at golf clubs. If I'm buying shoes, it's to walk, it's golf shoes, it's something about performance. So different brands, and we see this potential merging of these two brands, and we're going to see what happens, but you got to think about this. Remember when Dollar Tree bought Family Dollar some years back? And okay, they both are discount retailers. So of course, Dollar Tree is going to do a great job with Family Dollar. A few years later, and I want to say maybe 2 or 3 months ago, they announced they're selling it. They were not successful with it. So how can Dollar Tree, who's great at that brand, not be successful with Family Dollar? Well, just because you have two different brands that serve two different demographics, the store locations are much different. It's just a different business model. Not different business model. I'll say it's a different business, different brand, and they're serving different people. So don't assume that a company like Dick's Sporting Goods is going to purchase Foot Locker and just have massive success. It may not happen. So we'll see. Also, when you think about the benefits of these companies, I see this benefiting Dick's Sporting Goods. If anything, I don't really see how this enhances the Foot Locker brand. With Dick's Sporting Goods, now that with this brand that they purchased with Foot Locker, with all these stores and online as well, number one, now Dick's Sporting Goods can get a global reach since they are not overseas like Foot Locker is. So that's one benefit. Another benefit is they have more bargaining power when it comes to these retailers. Remember last year or a few years ago when Foot Locker stock started to sink down a little bit. Yes, their business was struggling, but Nike announced a more direct-to-consumer business model. So they figured they were going to remove some styles from the stores and sell those styles directly to the customers. Nike kind of moved a little bit too fast and went against customer trends. So they kind of struggled and kind of reverted back to putting those styles back into Foot Locker. But nonetheless, Foot Locker stock has been struggling. We're going to take a look at both Dick's Sporting Goods and Foot Locker to see how good is Dick's Sporting Goods. And we're going to look at Foot Locker to see how good this brand is or this business is that they're buying. So take a look at Dick's Sporting Goods to start it off. Right now, they're trading at about $167 per share. Solid trend. The stock has been flat for the past year or so, but this stock has done wonderful. Again, I bought it in 2018. I want to say my average basis in this stock was about $50, if I'm not mistaken. 2.9% dividend. They're paying $4.85 a year per share. Pretty solid dividend. And this company is pretty much climbing pretty strongly since 2020 with some volatility, but overall, solid stock. Solid movement right here. So let's go look at a few more stats. 13.3 billion market cap, a beta of 1.19, so not very volatile, a little bit more than the market. a PE of 11.9, so that seems pretty cheap. Earnings per share of 14.05. So let's take a look at this to see, is this company actually cheap? So let's dive right into the revenues here. So 2015, they were at 6.8 billion. Solid growth, only 1 year of negative growth here. Right now, they're trending to be at 13.4. Last year, they finished at $12.9 billion. So they're growing at a pretty solid rate, stable growth, 9.4% a year. It's not astounding growth, but this is a mature brand. So this is what we would expect. This is a mature company in a mature business. So 9.4% stable growth and pretty consistent other than 1 year in 2019. Let's look at the margins. After they deliver their products to the customer and cover those costs of their products, they are at about 31% over the past 10 years, 33.8% over the past 5 years. So solid margins for a retail brand. So pretty good there. Let's look at the profit. So some up and down, but overall strong growth. So 344 million. They had an explosion in 2022, and they've been pretty much not as high as 22, however, much higher than the years before. So $1 billion in 23 and 24. We have a few years of negative growth. 23, 20, 2019, 2017, 2016. So we have some years where the stock or the net profit did go down. However, it's trending up with these past, again, after this explosion, they've been pretty solid, much better than the years before. So highest net profit margin, 12.4 and 22. Last few years, they've been at an 8% net profit margin, 7.6 average over the past 5 years. So we like what we see here. Now let's take a look at the cash flow. The cash that they're generating from their operations minus their capital expenditures, which represents the required reinvestment back into the business. Where are they at? Similar to the gross margin, similar to the profit, $257 million, had this explosion, 1.3 billion here, 1.3 billion in 22. Dropped down, but they had another solid year of $940 million in free cash flow. So not as consistent as the revenues in margins, however, still positive. They're still going a little bit up and down depending on what they're doing, what they have going on in their business. This 5 year is kind of skewed because of 610% growth here. But over the past 3 years, they had averaged 3%. So the growth is there, but it's not consistent on the cash flow side. Let's look at the debt. All right, so $6 million going up to 2.6 billion to 3.7 billion this past year. So right now, they can pay off their debt with about 4 years of free cash flow. We want to see how fast they can pay off their debt. We want at least 5 years. We prefer 3 or below, but sometimes depending on the business model and what they have going on, it's going to be a little bit more. So only 2 years, I would say, of poor leverage. 2020, when they were at 14.3 years to pay off their debt, and 23, 6.6. Other than that, they kind of keep it around 4.1, around 4, I should say. 4 years to pay off their debt. So it's not the best, but pretty good, pretty solid leverage, a solid balance sheet there. Let's look at their dividend. This is what I love best about this company. Current yield, 2.7, expected to pay out $1.21 per quarter. The payout ratio. It's amazing that this company still has a payout ratio that's below 40%, given how much they've been paying out over the past, since I've owned the stock over the past 8 years. So 37.4% of the payout ratio. That means 37% of their free cash flow is given to shareholders in the form of a dividend. That doesn't include what has to go to debt or what's going to acquisitions and also share buybacks. But 37.4%, that means this company has a lot of room to grow. Now, I want you to see something. I'm going to make this a little bit bigger, so I don't think you can see it. Look at the growth rate of this dividend over the past few years. 10.2%, 10%, 105%. This was 49 cents to $1 per quarter. So they doubled their dividend 105% in 1 year. Before that, we have 11. This, not really a decrease, but they had a special dividend. They paid $5.94 per share in 2021. So not including that, let's go down 16%, 13%, 22%, 32%, 12%. This is every year they're growing their dividend at these rates. We haven't seen single digit yet, 10%. And then we have, let's see. So since 2015, they've been growing their dividend and double-digit growth every year. They haven't missed a year of growth, and they haven't missed a year as far as double-digit growth. Everything has been 10% and more. Imagine having income from your job, and you're getting a 10% raise every year. You don't really see that. In dividend growth stocks, you can see that. So it's important to invest in these types of companies, some of these boring companies that you drive by every day. Look at their dividends. Take some time out of your day when you see a company. Look at how much dividends that they have. There's a reason why you see these companies everywhere, and they're known by everybody. It's because they're the ones that are successful generating the cash flow and often paying a very strong dividend. This is an amazing dividend growth. And even with this acquisition, they have potential to continue to pay out this or continue to raise it at the rate that they're raising their dividend currently. So I love to see that. Let's look at shares outstanding. We want to see this trend. They've been taking cash flow and buying back shares. So each year that this drops, the existing shares are more and more valuable. If when the company buys shares and gets rid of them, takes them off the table, the remaining shares own more of the business. So holding this stocks for multiple years, you get this benefit where you not only are you getting a dividend, not only is the business growing, but they're increasing the value to the shareholders by decreasing the shares. Love to see the share count come down. So let's look at economic value added. We're comparing the return on capital to the cost of capital. How much money are they making? Comparing that to the capital that they have to use to make that money. So the cash on the balance sheet, the assets, the equity, how much do they have? How much capital do they have? The debt as well versus the return. Now, how much does that capital cost? What's the interest rate and the opportunity cost of holding that capital? So 19.4% is the return on capital. 4.2 over the past 5 years has been their average cost of capital, giving them a spread of 15.2%. So this company is creating economic value at the rate of 15% per year over the past 5 years. That's an amazing, I won't say amazing, but that's really solid to see that spread and see that growth. We want companies to continue to create value by keeping their doors open and running their business. So we love to see it. Let's look at the valuation for this stock. Now, I'm assuming a modest 5% growth over the next 5 years. I want a discount rate of at least 10%. Their cost of capital is much lower than that. So I think this is a great hurdle rate. Give me a little bit of margin of safety there. The average multiple. So they have been trading on average about 19 times their free cash flow. The market cap has been about 19 times their free cash flow amount over the past, I believe, 15 years. So I believe that's a reasonable expectation to expect the average free cash flow multiple if I were to sell the stock in 5 years. With that said, they're trading at $167. I believe the fair value is somewhere around $117. So right now, this stock is trading at about a 30% downside, 30% overvalued, in my opinion. So I think the stock right now is a bit overvalued, but still a solid stock. Now, with that said, let's take a look at Foot Locker to see they're paying $2.4 billion to buy another brand. Let's look at that brand and see where they're at. Real quickly, let's look at Foot Locker. Now, Foot Locker is right now trading at $23. But remember, after the announcement of the acquisition, this stock jumped up a lot. So they were at about $9 before they went up. So about $12 before it jumped to $23. And it's pretty much staying flat there since. So the stock has been on a downtrend, as you see, over the past year. And we have a significant jump because of the announcement. So that's people who are investing based off news. That's not what we do. Market cap of $2.2 billion. a beta of 1.4, so volatile, basically pretty much coming from this jump here. Other than that, I don't think the stock is very volatile. The PE, let's look at this PE, 124 times earnings. If you were to take $124 and give it to me, and I were to give you $1 of earnings, how fast does that dollar have to grow year to year for you to feel good about giving me $124? It would have to grow at a ridiculous rate. Because if you think about it, 100% growth would be $2 next year. So you will have $3 total, but you gave me 124. This is what you have to think about when you're looking at some of these multiples. Not to say that you can't buy a stock at 124 times earnings. Just think about what you're doing and make sure the growth of the company is there to justify doing that. So let's look at this stock. No dividend now. They cut their dividend because the business was struggling. So they are buying a struggling brand. We have to be honest about that. So let's look at revenues. First thing I like to look at when I'm looking at revenues, how many years of negative growth, how many years of decline. So we have -5 in 21, -2 in 23, -6 in 24. So we have some consecutive years of negative growth. And right now they're trending to be negative for the trailing 12 months. So this year they're trending to be negative again. So growth is very low, averaging 1% over the past 5 years. This is not typically a company you want to invest in, just based off of this metric. You want a company that's growing. Too many businesses are growing their revenues to invest in companies who are losing their revenues. So you have to be careful there. So let's see, they peaked in 22 and they've been coming down ever since. So let's look at their margins. Pretty similar to Dick's Sporting Goods. You got about 31% over the past 5 years. Some decline here in the past few years, 24, and now the trailing 12 months, their margins are shrinking a little bit, but not at an alarming rate. But the revenues are not good there. So will this acquisition grow the revenues of Foot Locker? We'll see. I'm not sure that's going to happen, but we'll see. Net profit. So a little bit all over the place. You got -57 here in 2018, negative in 2020, 21, 23, 24, and trending for the past 12 months. Well, we have a little uptick here, so that's wrong. So looks like it's going to be about 12 million this year for the trending so far. However, -25% in net profit growth. So 520 million. They peaked here in 2020 and with 893, but it's been down ever since. So not a solid trend here when it comes to profit. So margins look good, revenues don't look good, and profitability, gross margins look good, excuse me. Net margin does not look good. Free cash flow, similar story, many negatives, many down years. And over the past 2 years, we had 2 years of negative free cash flow. So this company is burning cash to keep their doors open. We don't like that. Let's look at debt. It's going to be bad because you have negative cash flow. So you're not generating cash flow to even pay off this debt or to be able to pay off this debt quickly if this company were to get into trouble, which it's in trouble now, in my opinion. So very poor leverage, not a good position for them to be in. So leverage is not really there. They don't have a dividend. They used to, but they cut it. Shares are coming down. So they are taking some cash flow and purchasing shares. Not sure if this is the best thing for them to do at this time, given their recent history and recent performance, but this is what they're doing. Economic value. They do have a spread, not as great as Dick's Sporting Goods, but they do have about 5.3% in value creation compared to the capital that they have on hand, the debt and the equity. So then let's go to valuation really quick. This company is expected to continue to shrink. So I have a negative growth rate for the next 5 years. Discount rate, 10%. Terminal value, it's been trading at about 8% average for the past few years. I would say past 20 years. This stock is worth $9.50. It's trading right now at 23. So at about a 60% downside based on my estimates. So the company that they're buying is not a very well-performing business, but their plan is to buy Foot Locker infuse it with their brand, and not so much infuse it with their brand. That's not the right thing to say. I don't believe that's going to happen. I believe the brands would be separate. I think they should stay separate. They don't want to taint Dick's Sporting Goods with the Foot Locker brand. However, with the bargaining power and efficiencies, hopefully they can enhance the results of Foot Locker. So that's up in the air. We'll see. So that's my analysis. I think Dick's Sporting Goods is a great company. I've been invested in this company for about 8 or 9 years. So right now, if you were looking to get into it, I would say dollar cost average, not lump sum investing, because it's very somewhat overvalued at this point in my estimate. So this is definitely one to keep in your watch list if you're not going to invest in it now. So Dick's Sporting Goods is great. Foot Locker, I'd say, since they're going to acquire this brand, and there is a premium that they're going to pay for it. So I believe the estimate was about a 60% premium based on that $2.4 million valuation. But the stock has jumped up since then. So I'm not sure if you're going to get much of a bargain by buying Foot Locker. If you are interested, you might as well, in my opinion, invest in Dick's Sporting Goods. And at least you're buying a solid business, a solid company, and that's going to continue to grow. And we'll see what they do with this acquisition. We'll see what they do with the brand. And I see this benefiting Dick's Sporting Goods brand, not so much on the Foot Locker side. So we will see what happens. So I'm excited to see what management does with this. So that's my analysis. Let me know what you think in the comments, and I hope to see you in the next video.